Okay, so to bring all those chapters back in, we do have a review for test number 4 for personal finance and the stocks, bonds, mutual funds, REITs, collectibles, etc. So, stock basics. Remember that corporations issue stock to raise money. Common stock gives you ownership and voting rights. Preferred stock gives you a fixed dividend, has less risk, but again, preferred means you have to have somebody out there to buy it. It doesn't trade on the stock market just like common stock does. And you get the fixed dividend and a first dividend. You get the first choice of a dividend also, first also. Stock splits reduce the price per share. Dividends provide income. I mean, you know that, you can think about that, but there is a reference to that question on the test that dividends are an income provider. Prices fluctuate with market conditions. They're not guaranteed to go up. They're not guaranteed to go down. They fluctuate with market conditions. Bonds, corporate bonds, it's a written pledge to repay us, the investors, with interest. Government bonds are considered safer, but they usually have a lower return. There is a bond indenture, and that's the legal contract that you use between you and the bond uh, company that's issuing the bonds. Interest is typically paid on bonds every 6 months. You can find other advantages out there and other times, etc. But for the test, interest is paid about every 6 months. They have a call feature, which means, like I said, think of that they can call you, and they can ask to have it purchased. They can purchase it back from you before it matures. So if you have it for 10 years, it has a call feature. If they finish their project and want to stop paying interest payments and etc., they can just call you up and say, "Hey, I want to terminate this bond now." They'll pay your face amount that you were promised, but you just miss out on that extra interest. Um, a good reason to invest in bonds is because of the income. The fact that your principal is returned to you at maturity is kind of a nice perk. It's a return of your investment and then return on it also. And then it also allows you some diversification. Bond markets typically don't work the same as stock markets and interest rates, so that gives you another faction in there to have an alternate chunk of money invested in that's not tied to one of the other two markets that you're looking at. There are also, in addition to government bonds, there is treasuries from the government, and there's what they call treasury bills or T bills, treasury notes or T notes, bonds, of course, or the TIPS, which are the inflation product that they have. So just know what each one of those means and is defined as. Mutual funds, think of it as a pool of money managed by professionals. That's what broken down through all that chapter when we were discussing it. That's pretty much how to refer to how it is summed up. The advantages of mutual funds is they offer diversification. Even if you're in one specific type of fund, growth or equity or tech, it's going to be a group of investments that make that up. So it's not just all in one company or all in one stock. Um, and they are professionally managed. So it's like having a broker, but not having a broker. You don't have to pay as much for that. So that kind of helps too. There are types of mutual funds. There's open-ended, closed-ended, no load, and load. No load and load have to do with fees and when fees are charged. And open-ended and closed-ended have to do with, again, with fees and how they're started and ended, when the fees are charged at beginning or at an end. Know each one of those breakdowns and what they mean. Global and socially responsible funds are available. So that's on the test also. Know that there is that option to have global and socially responsible funds if you want them. Sales charges, load versus no load. That's where the sales charges are written in. Management fees are in every mutual fund. There may be withdrawal penalties. It could be, especially if you're in like a fund that's buying CDs, there may be a penalty for early withdrawal or something coming out early. They also may give you a penalty for it's an IRA and you take it out early, so maybe a penalty there. There could be some penalties that are involved, as well as just the investment product that you're in may have a penalty. Alternative investments, we just covered those: real estate, REITs, um, buying property direct. And we looked at buying indirect and direct. And indirect was a REIT or a real estate investment trust or a syndicate. or an LLC, and then buying direct was you just going out and finding property and buying it, whether it's investment or whether it's a piece of land or whether it's your own home. Um, REITs trade like stocks, and they distribute about 90% of their income. So that means about 10% of a REIT is for fees. Precious metals and gems, those can be great. They can hedge against inflation. They're easier to carry if they're gems, as we talked about storage issues with precious metals. But you can buy shares of stocks that trade in that, et cetera, without having to buy the actual gold bullion cube. And they do hedge against inflation. They kind of, right now they're at their all-time high, but inflation's going up. But as inflation goes up, they may give you some security there too. Collectibles are considered risky and they're considered illiquid. And the risky part comes from, you have to have a buyer and you have to have someone that appreciates it. You could have a $20,000 stamp collection, but if you don't find the right buyer, they may only give you 15,000 or 10,000. So, that's where the risk comes in. And then they could be illiquid, which means, again, doesn't mean you can't ever cash them. It just means that it takes a while to get the cash. And because those are specific private traded market kind of things, they're not out there for the general public. Not everybody's going to appreciate a stamp collection or diamonds. Then you've got to find a buyer when you're ready to sell. And then you have to wait for that cash to clear and et cetera. So that's the reason it comes into that category. Stocks have growth potential. Some of the stocks have a higher risk, and there is a higher risk inherently in stocks just because you're buying into the stock market. Bonds offer a steady income. They have a lower risk because a lot of bonds don't fail. There are some that do, of course, but typically if you're buying from a reputable company and or the government, you're expecting it to get your income back. So it's considered a lower risk, but with a steady income. Mutual funds are considered a balanced risk and they have professional management. And they, because they could have a high risk in some of the funds, a low risk in some of the funds. That's why it's a balanced risk plus it's spread out. So it's trying to give you that diversification off the top. And again, you have somebody that can professionally manage it that you're not having to pay for. Well, you are with your fees, but you're not having to. If you go in and see your broker, they're going to be charging you a monthly fee on what you have invested with them. So that's what you're trying to avoid. Excuse me. Alternatives, the alternative investments are considered speculative. They often have what they call inflation hedges. So if inflation's really out of whack, they may provide some stability in there and may give you some cash that other people don't have access to, because the market's wonky or because bonds are wonky. You've got this other thing. So, but they are speculative. So you've got to keep that in mind. So don't forget, we're matching our investments with our risk tolerance. Know your risk tolerance. If you have a high risk and can handle it, go for it. If you have a low risk and can't handle it, if you're laying awake at night, you're worried about it, you're watching the market all the time to see if you've lost money, maybe get in something that's a little less risky for you. And if you're in guaranteed, just make sure that you're keeping up with having, like, if you have everything in a bank, make sure it's all under the FDIC regulations so that if the bank goes under, you get all your money back. Diversification is key in anything, and that doesn't necessarily mean that you have to have stocks, bonds, mutual funds. You should, especially if you're trying to amass a fortune. You need to be sure you have something probably in everything, or at least a little diversification in today's economy. Um, and if you're all in fixed, you can still diversify by having some in a money market, some in a CD, some in a long-term CD, some in a short-term CD. You can look at those things trying to make sure you've covered all your bases. So just know that diversification is key. Some of us approach investing with a long-term strategy. We're looking at retirement income, so we're looking at when we start saving and start trying to build our portfolio. We're looking just at what's it going to be in 30 or 40 years. Some of us will look at it as short-term speculation. What can I make today? What can I make this week? What can I make this month? And so just know which category you fall into, and you may fall into both at different times. That's fine too. That's just the two options that are out there. The test is 50 questions, multiple choice, true, false, as before. I've met with tech. They think the workaround so the test will not disappear. If it does, of course, let me know. It is not in Honor Lock. It is in Respondus. I was feeling a little jinxed with Honor Lock, so I just didn't even try that with this one. It is open note. Show your work at the end. If you have questions, of course, give me a holler. Thanks. and good luck.